As an investor, I believe the best opportunities are found by focusing on great businesses, not by chasing market noise. Today, I want to walk you through 5 companies that I not only think are interesting, but that I own in my own personal portfolio because I believe they provide excellent value right now. These are all household names, but the reasons I've invested in them comes down to key changes in their fundamentals over the last year or so. While the market gets caught up in the day-to-day headlines, I've been focused on the numbers. When you spend years analyzing companies like I have, you learn to spot when the underlying business is signaling something important. And right now, the data for these 5 is telling a story of significant underlying strength. So in this video, I'm going to give you a clear data-driven breakdown of why I've invested in these 5 companies and why I think they offer compelling value. We'll cut through the hype and focus strictly on the numbers. Before we start, the usual disclaimer, I'm not a financial advisor. This is purely for educational purposes and reflects my own research and opinions. You should always do your own due diligence and speak with a professional before making any investment decisions. So why these 5 companies? Why are they in my portfolio? I don't just pick names at random. Most of these stocks have something in common that I always look for: a durable ability to produce high returns on capital that they invest. When building my portfolio, I look for 3 things. First, globally recognized brands with a strong competitive moat. Second, recent positive data that confirms the business is getting stronger and not weaker. And third, a clear runway for future growth. For me, these 5 companies check all those boxes, which is why I've invested in them. The first position in my portfolio we'll discuss is the financial technology giant Mastercard, ticker symbol MA. Many people think of Mastercard as a credit card company, but that misses the point. What you have to understand is Mastercard is a global payments network. Think of it as a toll road for money. It doesn't take on consumer credit risk, it simply collects a small fee every time money moves through its network. My core thesis here is the global multi-decade shift away from cash. Every year, more commerce moves to digital, and Mastercard is perfectly positioned to benefit from this long-term trend. But the reason it's a core holding for me now is because of its recent outstanding performance. Let's look at the proof in the numbers. In the third quarter of 2025, Mastercard posted powerful results, with revenue surging 17% year over year to $8.6 billion. That level of growth for a company this large is phenomenal. A key driver was cross-border volume, which is spending from international travel and e-commerce, and that was up 15%. As global travel and online shopping continue to expand, this acts as a massive tailwind for the business. Mastercard isn't standing still either. It's aggressively expanding into new payment technologies and value-added services like data analytics and cybersecurity. For instance, its Mastercard Threat Intelligence Service and its payment partnership with Uber are opening up new revenue streams and making its competitive moat even larger. So what's the potential from here? Analysts are bullish. The consensus 12-month average price target sits around $650. With the stock trading at around $560, that target represents solid potential upside. Of course, risks exist. Rising operating expenses and potential regulatory hurdles are worth watching, but with its resilient business model and multiple avenues for growth, Mastercard presents a compelling case for why it's in my portfolio. Alright, the next company I own is one that has undergone a radical transformation. Meta Platforms, ticker symbol META. Just a couple of years ago, the narrative was dominated by massive uncertain spending on the metaverse. Today, the company is much leaner, more focused, and incredibly profitable. My investment thesis for Meta is built on its renewed commitment to operational efficiency. While the metaverse division, Reality Labs, remains a long-term money-losing bet, the core advertising business is firing on all cylinders. What's truly impressive is how Meta is leveraging AI. This isn't just a buzzword. AI is materially improving user engagement and critically the effectiveness of its ads. The data from its recent third quarter earnings tell the story perfectly. Meta reported fantastic results, with sales growing 26% to $51.2 billion. Its family of apps, Facebook, Instagram, WhatsApp, and Messenger, saw daily active users climb to an astounding 3.5 billion people. That massive user base powers the ad business. More users means more ad impressions, and thanks to AI, those impressions are becoming more valuable, reflected in a 10% increase in ad prices. Now, if you only looked at the headline numbers, you might have been concerned. The company reported a one-time tax charge of $15.9 billion. That made its net income appear artificially low. But if you exclude that charge, the underlying profitability of the core business is staggering. The market seems to be wrestling with Meta's huge investment in AI infrastructure, with capital expenditures projected in the $70 to $72 billion range for 2025. This has created some volatility, but is exactly where the opportunity lies. These are the investments that I believe will power its next phase of growth. While some price targets are conservative, Morningstar maintains a fair value estimate of $850 per share, viewing the stock as undervalued. This is why I see Meta as a strong and key holding. It's a dominant tech company that has emerged from a challenging period stronger than ever, with a clear AI-driven strategy. Moving on to the third stock from my portfolio, we have a company that's become a verb. Uber, ticker symbol UBER. My investment case for Uber is straightforward. It is the clear market leader in two enormous and expanding global markets, ride-sharing and food delivery. Uber's business has matured significantly. It's no longer about growth at any cost. The company is now demonstrating consistent, impressive profitability. It benefits from a powerful network effect. More drivers attracts more riders, which in turn attracts more drivers. It's a virtuous cycle. Recent data confirms that its monthly active users, total trips, and user engagement are at all-time highs and still accelerating. The numbers back this up. For the third quarter of 2025, revenue grew 20% year over year to $13.5 billion, and total trips climbed 22% to 3.5 billion. The company operates in sectors with powerful secular growth, commanding a significant premium to the broader market. The consensus among analysts is a strong buy rating, with an average price target of around $108 per share, representing solid upside potential from the current price. But what about the future? A major catalyst is the long-term potential of autonomous vehicles or robo-taxis. The timeline is uncertain, but Uber is perfectly positioned to capitalize on this shift. It doesn't need to build the cars, it just needs to integrate them into its industry-leading network. This is the critical advantage. Uber is also expanding its platform power through partnerships, like its collaboration with Toast for restaurant delivery and a payment partnership with Mastercard. These moves improve the user experience and increase customer loyalty. While some might see the stock as fairly valued after its strong performance, the long-term growth story remains compelling, and it's a big reason why I own the stock. Next up, at number 4, is the king of streaming, Netflix, ticker NFLX. For years, the narrative around Netflix was all about subscriber growth, but the company has executed a brilliant pivot. The new story, and the reason I've made it a part of my portfolio, is its focus on profitability and generating massive free cash flow. The key drivers here are a successful rollout of its ad-supported tier and the crackdown on password sharing. These initiatives have converted non-paying viewers into high-margin paying customers. In fact, by 2025, ad tier revenue is expected to surge, which is fundamentally reshaping the company's financial profile for the better. Let's look at the third quarter 2025 results. Netflix reported revenue of $11.51 billion, a 17.2% year-over-year increase driven by both strong membership growth and the new advertising income. Its operating margin hit an impressive 28%, and even more telling, Netflix raised its full-year free cash flow forecast to $9 billion. A company generating that much cash has tremendous flexibility to invest in new content, buy back shares, and explore new growth areas. Looking ahead, the fourth quarter of 2025 is projected to be even bigger, with a revenue forecast of $11.96 billion. The content slate is powerful, with the final season of Stranger Things and, for the first time, live NFL Christmas games. Although the stock dipped after earnings due to a one-time tax expense in Brazil, the underlying business fundamentals are stronger than ever. Netflix has successfully transitioned from being a high-growth, cash-burning company to a mature, highly profitable entertainment giant. Its proven ability to generate this much free cash flow makes it an incredibly attractive business that I want to own for the long term. And finally, the fifth stock from my portfolio is the giant of e-commerce and cloud computing, Amazon, ticker AMZN. To truly understand why I own Amazon, you have to view it as two distinct, powerful businesses combined into one. First, there's the colossal Amazon.com retail business. In the third quarter, its North American and international segments generated a staggering $147.2 billion in revenue. However, this business operates on very thin profit margins at around 4%. The real story and the secret to Amazon's financial power is Amazon Web Services, or AWS. In that same quarter, AWS brought in $33 billion in revenue, but with an enormous 34.6% profit margin. This is the high return on capital engine that powers the entire company. AWS is the true profit driver, generating massive amounts of cash that Amazon uses to fund everything else. Global spending on cloud infrastructure is surging, much of it driven by the generative AI boom, and AWS remains the market leader. While competitors like Microsoft and Google are growing faster in percentage terms, the sheer scale of AWS is hard to overstate, operating at roughly $132 billion annualized run rate as of Q3 2025. The demand for cloud and AI services is locked in for the foreseeable future. This dual engine model is what makes Amazon so compelling to me. The company is a cash-generating machine expected to produce billions in free cash flow. Its leadership in e-commerce, cloud, and digital advertising gives it an almost untouchable strategic advantage. The power of AWS is hard to comprehend. During massive sales events like Prime Day, it processes hundreds of millions of records per second. This just illustrates the foundational infrastructure that supports not only Amazon's own retail empire, but a huge portion of the modern internet. For me, Amazon offers a unique combination of a dominant consumer business and a high-growth, high-margin tech engine, which is why it's a cornerstone of my portfolio. So there you have it, a look at 5 companies from my personal portfolio, each with a data-backed reason for why I believe they offer great value today. We have Mastercard, the essential toll road for global digital payments. We have Meta, a story of newfound discipline and AI-powered advertising dominance. There's Uber, the undisputed leader in the on-demand economy. We have Netflix, the streaming king that has become a free cash flow machine. And finally, Amazon, the retail and cloud titan, powered by the incredible profit engine of AWS. Each of these companies is a leader in its respective field, with a powerful business model and clear catalysts for continued growth, which is why I'm confident in owning them. If you want to see more deep dives into companies I'm investing in, make sure to subscribe to the channel so you don't miss the next video. Now, I'm curious to hear from you. Which of these 5 companies do you own or are you watching? And are there any other great businesses you think offer compelling value right now? Let me know in the comment section below. Thanks for watching, and I'll see you in the next one.